something like a family-owned SME that is already long established and successful. They might also be tempted into an innovative startup, not even innovative startup, but an innovative midlife company, 10, 15 years old. Why is that? This money that they're investing, held by investment banks, is typically coming from pension funds that need a return, and they have a very low tolerance for failures. So it's in their interest to invest in very stable long-term businesses. So that group are typically looking to channel the money through an established private equity fund. Sometimes, but not always, they may be attracted by a private equity fund that is also bidding themselves or putting themselves out to be an impact manager of impact funds. Why is that? Because if you're going to invest, you may as well also impact the world positively. I think this is in a way connected to the environmental lobby. Environmentalists were the first to say, your investment dollars have an impact on how the world is governed. So profit, yes, profit is important, but they choose to put the money into oil or tobacco or firearms. And a lot of investors today will not invest in those things from that angle. Pressure groups, and also a feeling that I'm impacting the world positively. So they've got a much narrower focus in terms of where they can go. For the second group here that have got the green bar, you've got pension funds, development banks, multilaterals, and governments, okay? They are typically longer term investors who are looking to end up in the infrastructure space, okay? Not exclusively, but it's their preference. And they'll typically be investing it through either an SOE fund or company, similar to something like IDC, or you would have an SPV that is set up by an entrepreneur. So there's some entrepreneurs that are very good at setting up highly regulated industries. So you might find something like power generation has got a lot of steps that need to be met by the time you can get a license to operate a power station. So typically you have your SPV entrepreneur who will attract governments, multilaterals, development banks, and pension funds directly to invest in something like a power station, which goes into an infrastructure project. It's long-term, predictable cash flows. Over here in the next group, you've got high net worth individuals and family groups. So those are long-established business families and business groups that are very successful. And they're saying to themselves, okay, they're not purely in it for investment purposes because they already own successful businesses, but they're looking and saying, as I park my money, where can I put it where I'll have an investment? And sometimes they're willing to take losses. Sometimes they're willing to support ventures that nobody else would. So you'll see the line there sometimes connects into angel investors, because sometimes they are the angel investors and they'll be much more willing to invest in things like tech startups. You've got venture capital funds, they're key investors into there. And through that, they may go into higher risk ventures and also the family owned. That's their typical investment path. They can also invest in like general innovative startups as well. It's something that they appreciate because as a family group, they know how to scale this type of business. So they have a key role there. Philanthropic, it's people like Mo Ibrahim. Mo Ibrahim are the type of investors who have achieved the fortune and they're not really in it for the money. They're not looking to amass wealth or gain, but they're looking to change the world. So they're looking to invest in things that are transformational. And they are higher risk investors. They're looking for any type of investment. Typically, they could be angel investors. They could be part of a venture capital fund, but they're also very active in impact and private equity. You have seen things like Tony Elemelu Foundation, and he's leading a huge fund that's coming out of Nigeria looking to be a catalyst for SME development across Africa. Then you've got what's called expansive trade. So in expansive trade, you've got an organization, let's say something like Coca-Cola. Sometimes they've got their own private equity firms that are in-house or a private equity firm that they're closely affiliated with. And what they're looking to do is invest in their sector across different countries, because over time they may choose to invest there and they'll have a sister company in those markets. So that's one way in which they do that. Going on to the next slide, the flow of funds, okay? Once, we'll say the investment officer, to give a little context, we'll say that this is the point where an intermediary is looking for someone to invest in, okay? As an SME or someone looking for investment, you have to realize that in as much as you are looking for investment, people are also looking for you. You represent an opportunity. They're sitting with funds that need to be deployed, and they're looking for a safe bet that they can invest in, okay? The first point of contact will normally be your investment officer. The investment officer is looking at a wide range of opportunities that are there, okay? And they're saying to themselves, okay, I need an investment that I can take forward to my investment manager that they will agree with, and we've got a chance to take it past the director and all the way to a committee. So here I'm summarizing the steps that a typical investment will come with. Let's imagine that I'm involved in agriculture and I've got a new way of trading agricultural produce, okay? I take it first to the investment officer. He needs to convince the investment manager that I'm investment worthy. When the investment manager is convinced, they'll have an internal meeting with the PE director, who's a partner in the private equity firm. The next stage is it'll go to the investment committee that may or may not have some of the financiers in there. If they are convinced by the opportunity, they'll put forward a conditional approval. The conditional approval basically says if nothing new that is negative comes up, you may go ahead to award. So the first thing they'll do is they'll probably have an in-house due diligence that will take place. The in-house DD is saying, okay, let's quickly look at the key things. Are they registered? Do they have accounts? They'll have an internal checklist. After that, it'll be escalated to third-party review. In the third-party review, you would have a technical, financial, legal, tax, legal, and regulatory compliance review. So in the technical review, they'll be looking at the business and the business model and saying to themselves, okay, what are you investing in? Is it going to be there 3, 5, 10 years from now? On the financial review, they will be looking at saying, okay, financial position of the company, is it growing? Is it not growing? Are the financials prepared correctly? Do they have clients? On the tax, legal, and regulatory review, they'll be assessing specific risks to say, will this business be here 5 years from now? Could it actually collapse overnight and we lose all the funds? Because the PE firm that are investing bear responsibility to their shareholders for money that is won and money that is lost. So as a result of this, you either get an approval or a rejection, and that'll probably be the outcome. Now, in our experience, we've seen a 60% failure rate with deals that we've been dealing with locally. Common reasons for this, and I'll quickly spell them out, is one, people have overvalued the business. So the way that they value the business does not connect with the normal way that the PE fund can turn a profit on the investment downstream. The second one is unrealistic forecasts. Sometimes you can have business at the right value, but your forecasts are too ambitious. You've never achieved those results before, but now you're valuing the business on that basis. Another one, financial stability tests. These are things like someone previously was declared bankrupt, the business is heavily leveraged and could go down at any moment, lots of debt, undeclared debt, etc. And then another one coming through there is failed on the basis of transaction. So, for example, we've seen situations where company will come forward and say they've got a license to achieve or to run a new telecom center or something, a new telecom provider. When it's actually checked, they don't have the license. They've been given an option to acquire the license and so on. And then the background check. Who is actually sitting behind the business? What do they represent? You could have criminal and other entities involved in that. So let me quickly move from there to tax, legal, and regulatory. Key things you need to understand. With a bank, their primary objective, a commercial bank, is looking at the cash flow because they may have a long-term relationship with the client. And they can tell the volume of business that they normally do. And they'll typically use cash flows as a proxy for the ability to repay. With a private equity investor of some sort and an impact investor, they may be meeting you for the first time and have no prior knowledge of your business. That means that your compliance functions are extremely important for them to get a sense if they want to invest or not. Okay, and the stakes are high. They're very high because typical examples of things that could happen. Could the company cost us money after the purchase? You could have a private equity firm invest in an organization, and then afterwards they discover that they've got lawsuits, for example, that create negative equity. Everything you put in is lost and you owe money. There's a famous example of an ongoing battle in which the German pharmaceutical company Bayer purchased Monsanto globally. In the US alone, Monsanto has got 5,000 lawsuits that have been placed against them for various issues around their business practices. The argument is that if those things are not resolved, the investment could potentially be worthless. Next one, could the company be closed for non-compliance? We've seen situations, particularly in highly regulated sectors, where your investment disappears overnight. If you own a television station and for a breach that happened a year, 2 years ago, the IBA withdraws your license, it's gone. That investment could be gone and it may not be possible to salvage it, okay? Does the business owe taxes that need to be settled, okay? There are all kinds of taxes that could be there sitting in the background. And you only really know this when you do a final check. ZRA may not even be aware of the taxes that are outstanding. The business model alone might trigger certain tax implications that people haven't thought of. Or regulator, you could have an organization like NAPSA. For context, NAPSA was a successor to what was NPF before that. They found that NPF collapsed because they charged contributions and then people couldn't pay and they wrote them off. So instead, what ended up happening is that when they reformed NAPSA as a new entity, it was put in the law that they were not allowed to write off the amounts. So if you owe NAPSA money, your best hope is to enter into a payment plan. But immediately the liability doesn't go away. And it actually accumulates at a rate of 10% per month for the outstanding amounts. You could have missed a payment 5 years ago. Today, you could owe a vast sum of money because you weren't compliant with that. Also, could you face regulatory sanctions? Somehow linked to the issue of a regulated sector, could there be another regulator that is looking at your business practices and could outlaw the way that you operate? Simple things like refunds that you give, whether you're actually domiciled here, if you're a tech business. There are a lot of areas that need to be checked because without these, the investor could lose everything. And they can't afford to have investments that will just disappear overnight. So to kind of look at this, I mean, here are the challenges, but what can the entrepreneur do about this? And there are a lot of things. Many of the solutions are free. They don't actually cost money to implement. The first one is when you're setting up the business, you need to prioritize compliance and move away from this culture where we say, I'll sort it out later. That has buried a lot of good opportunities. We've gotten to the very end of an investment process. The investor is ready to put money on the table, and we find one glitch of something that they were aware of but didn't really take seriously early on in the business. So the next one is engage the financier. Certain financiers from the outset will actually share with you issues that are of concern to them. They may or may not give you a checklist of things to look out for, but I would say that quite often they'll have an investment philosophy or guidelines that they are often willing to share. Acquire those checklists because the sooner you start complying with that, the more likely you are to get funded. The next one is to engage with regulators to resolve common issues. And I'll give an example of this. A client of mine was doing a rental business where they were operating in compounds. The way that the law is currently structured for rental income is that your tenant is meant to withhold the taxes and pay them over to ZRA. The reality is it's highly unlikely in certain environments, and a compound is one of those. So instead, they wrote to ZRA and said, this is our situation. Can we receive the rent in full and remit the taxes to you that way? And ZRA were willing to do that. So you often find highly skilled people who work in these regulators. And if you put your case forward, you've got an opportunity. It's also small things like you have a due date for your returns. Places like PACRA, it's quite possible to prepay amounts and then just have the return coming in, which they look at favorably. Or you can actually submit your return ahead of schedule and come and make any changes if you make any adjustments between that date and the final submission date. Also, make use of digital channels. You'll notice ZRA and others have actually launched a series of offices in shopping malls. RATSA has done the same thing. What a lot of people don't know is that they offer free advice and training on the use of digital channels to help you avoid standing in queues, which is a challenge a lot of people face. Making use of their portals because there've been a lot of upgrades to the systems and more are coming. The next one that you can do is that certain sectors have got specific regulatory challenges. You can lobby regulators through chambers. There's American Chamber of Commerce, British Chamber of Commerce, EU, ZACSIMBA, which is focused on small businesses, even Zika, who actually input into the budget every year, and Prospero as well, who act as advisors to the government in terms of policy and matters that they can change for SMEs. Quite often, business people running SMEs are of the view that the regulators have a clear understanding of the challenges that they're facing, and that's not always true until they articulate the challenge, and you might be surprised how willing they are to engage you and actually address the issues that you've raised. So I promised a short presentation. This has basically been it. Please feel free to go ahead and ask any questions that you have, and also to engage us outside of that. Okay, I can see a number of messages appearing here. Some people lost sound, they got it back again. Okay, are there any questions out there? PowerPoint, is it visible now? There've been a number of tech issues here. We'll make sure to share the slides if anyone has any questions relating to them directly. Okay. I can see something from Armin. No, that's just a general comment. We have a couple of minutes left. Are there any questions in the room? Anybody here?
Sorry, Mafipe, I was going to type. Well, Armin just asked a question, but I just wanted to ask, I mean, so I'm just thinking about that diagram that you had where it was all the tangled lines, and, you know, and I realized, you know, you're creating an idea, as you said, it's not an exclusive approach that any investor would take, but that certain investors tend to go for certain types of investment. And it has to do with their risk appetite, their ticket size, etc. But in the context of impact, you know, you made the point, the second wave of impact investment in Zambia. And it's quite a cynical question. But for like your more corporate and commercial investors or investment banks, how real do you think the interest in impact is? Do you think like it's something that's genuine, or do you think it's more that there's pressure, as you mentioned environmental lobbyists, that it's more that there's this perceived societal investment pressure? Or do you think there's, I mean, I'm just curious as to whether, you know, in your sphere of influence, whether you've seen like genuine belief that there is a balance between your risk profile, your social and environmental impact, and your financial return from investors, from maybe even truly corporate investors.
Really good question. I mean, the truly corporate investors will tackle it in that order. Number one, does this have commercial value going forward? Number two, do we have a story that we can tell? Because they're marketing themselves to funds as well by saying, we are actually involved in agri projects across Africa, and they're investors who will choose them over others for that reason. So it's a business survival issue. There was a time, it didn't matter what industry you were in as long as it was profitable. You could be dealing in firearms and that was okay. But now people come and say, hold on, are you damaging the environment because our fund doesn't want to invest in that? So they've got an existential need to be connected to things that are impact driven as well, because somewhere the funds will be invested. So if you are able to show that you're changing lives as well, even the hardcore investors are interested in that. Okay, Armin Bauer, what would it cost to engage KPMG advice per day? That's a very good question. How much does it cost for a flight from London to Lusaka? It varies. But what I'll basically say is this. It depends on what you're looking to do. We've got a vested interest in local businesses succeeding. So we're not looking to charge them more than they're going to get benefit for. There are many situations where people have come to us and said, we would like this service, and we've said, it doesn't make commercial sense for you or for us. I think a better approach would be for you to reach this stage and then come back to us, and this is the service that we can provide to help you on the journey. So I can only encourage you to get in touch with us, and we can give you a more specific answer to that one. Another question that's appeared is the impact, understanding of multilateral development bank is different from that from IFCs, VCs and PE and the likes look more into impact econ growth. We'll look at social. The overlap is a bit impact on tech and innovation. Not sure I understand the question, but in a diagram that I'll show, and I'll try and launch it again on screen. Let's see if we can get it to work this time. We're looking at the diagram over here, and I hope you can see it. It's trying to connect different investor types to intermediaries they use, and on the far right-hand side, the type of company that they typically invest in. It's not locked in that space, but it does work like that. I think I got a question coming through. Christian, I can see your question. The Zambia National Advisory for Impact Investing, Board for Impact Investing was inaugurated in December 2018. Okay, let's see if there's a question at the very end of it. It'd be good for KPMG to join the group. I agree with you. I'd like to come there and have more of an input there because it's a good platform through which we can work with a large number of SMEs without necessarily charging them fees, because we also have a very important angle around social good. We're meant to be strengthening our economy here. It benefits everyone, including KPMG. Are there any further questions before we disappear? I think we're winding down. I'd like to thank everybody. Well, thank you very much for that, Chilombo. I'd like to thank everybody who took time to join the session here. As we said, please feel free to get in touch on Twitter, by email. I'll share my details, and hopefully the organizers at ICA can also share the presentation. Thank you so much for your time. Thank you very much.